And welcome everyone. Please let me know you can hear my voice and see my screen. Great to see everybody here. My name is Jim. I've been with Steve for quite a number of years. And I welcome you all to Beat the Market Maker Open House. Hope you guys are doing great. You can hear me, you can see me. Excellent. All right. So we're going to cover some information tonight, which is extremely basic, but when you put it all together, it drives 80% of what you do as a trader. There's a lot of people that don't like the idea of there being a secret group that runs price. I get it. There's a lot of reasons people don't want to see that. I want to make sure you're given the real information tonight so you can weigh it on your own to see if it's something that makes sense for you. I can't make you believe anything. I don't want to try to make you believe anything, but I hope with the evidence shown to you, you're going to start to think about the market a little bit differently. That's my objective here. So I want to just first off ask you guys and gals, what instruments do you trade? Just pop it in the chat if you could. I'm just curious as to what markets you guys trade. NASDAQ. Okay. So Forex. Good. Okay. So we've got some index futures traders here. That's good. So that's one of the things that I've been focusing on for the last couple of years is the index futures. It offers incredible volatility during the times of the day. Typically, we were asleep as spot Forex traders. So that's a bit of sunshine in the life of Beat the Market Maker trading is the fact that you can trade up until 4 p.m. So Forex. Okay, great. I appreciate you guys popping that in there. Let me ask you guys what your ideas of a market maker are. What do you think a market maker is? Now, do you believe in it? Do you think it's smoke? Do you think that Steve came out 15 years ago and told you this story about market making because he was making it all up? Right? We want to make sure that you understand what a market maker is, because from there you can extrapolate all of the information that we give you to then turn it into a great career for yourself. That's what we're here for tonight, is to plant seeds in certain souls who want to take this and make a career for yourself. That's why I'm here, is to help you out. And I can assure you it's not about the money. That's not it. Okay, so answers are coming in. One who provides liquidity. That's a good answer. The ultimate player in the game we play in. I like that answer. Boku Pips is the name of the individual that typed that in. That's awesome. Market maker there to hit your stops. Generally speaking, yeah, but he does a little bit more. Okay, market makers are the controllers of the market. To some degree, yes. And this is where we get into the reason we need to define a market maker, because there are times that the market makers step in and there are times that they'll allow the participants to run price. And that's really what I want to start to emphasize for you right here at the very beginning, that a market maker is usually in balance, oftentimes hedging. We're going to go through all of this in detail, but I want you to start to form for yourself a picture of how the market makers really operate. And then from there, learn. You're very welcome for the opportunity. Stanley, thanks for typing that in. I appreciate you. So let's start out by going into Google and typing in, what is a market maker? Let's read together. A market maker is a firm or individual that provides liquidity to a financial market by continuously quoting bid and ask prices for a security, facilitating trades for other investors. And here's where you get the kid that's coming out of the kitchen who says, Daddy, I didn't take the cookies. Like, why did you say that to me? What? So here's where they say it. They profit from the difference between the bid and the ask prices, known as the bid-ask spread. Why would they tell me how they profit right away? That's the first bit of skepticism should enter your mind when you read that. By standing ready to buy and sell, market makers ensure that assets can be bought or sold quickly and efficiently, keeping markets functioning smoothly and preventing large price swings. So let's dig into this language a little bit. Continuously quoting prices. They are the source of price. They profit from the difference between the bid and ask spread. Do they profit from anything else? That's the question I want you to think about, right? They ensure that assets can be bought and sold quickly and efficiently. So they're always in long and short. That's the idea, right? If they're always ready to sell you something, they must possess it, right? If they're always ready to buy something from you, they must possess the short side, right? So they need to be in both sides. They're always long and short. And this is where it starts to get interesting. Keeping markets functioning smoothly. Securities can be bought and sold quickly, preventing large price swings. They admit that they contain and control prices. If you're an entity that provides the liquidity for the markets and you're using the terminology, I keep the markets functioning smoothly, I prevent large price swings. Well, by assumption, that also means that you're containing price. You're able to control prices. Let's dig further. Risk management. To protect themselves, the market makers, from potential losses due to price fluctuations, market makers often use hedging strategies to offset their directional risk. Well, wait a second. I thought they were always hedging. You mean there are times that they're not hedging? It's interesting how language itself oftentimes is a dead giveaway of the underlying principle to be discovered. Often use hedging strategies. So I asked the question, well, are you guys ever one way? And what about potential wins when you guys are all in one direction? What if everybody else is the other direction and you're in the opposite direction? Well, logically speaking, you'd make money off that, right? Oh, they're starting to see what I'm trying to give you here. Investor efficiency. Market makers provide quick and seamless execution of trades, making it easier for investors to enter and exit positions, especially those that are super desperado to make money, right? I want to get everybody in. Well, what happens if they're all one direction? What if most participants are going long or short a particular instrument and I'm the market maker? How do I benefit from that? Especially if you get one of these stampedes through the gate, right? Are humans suggestible? Is it easy to put humans into a state of mind where all of a sudden they all do the same thing? I'll let you think about that one. Would the market makers ever be one directional against the herd? Did they ever do such a thing? And again, it brings us back to this idea. Do they profit from anything else besides the difference between the bid and ask prices? So all of the sources where we're getting this information are approved market sources that oftentimes are owned by the firms that would have a relationship with the market maker. So this is all their words about themselves, right? And again, I'll ask the question, do they profit from anything else besides the spread? And if they do, what is their strategy? And that's where we want to start tonight, ladies and gentlemen. Is what is their strategy, and can we fit something in that's in harmony with their strategy? Let's continue. Price stability. By continuously supplying liquidity, the market makers help to prevent extreme price volatility and ensure price continuity. They're selling themselves pretty hard here, are they not? And again, this is the key. This is the key right here. They're going to prevent extreme price volatility. What will that tell you? Well, reversals might be a good play because they can always take a trend and whack it down, right? Or up, depending on which side. I hope you're starting to look into this in a way that you might not have looked into it before. And this has always been the most refreshing part about working with Steve for 15 years. The guy's been going for 15 years. And I'm going to show you charts tonight from 2013 that he posted as PDFs that look exactly the same as stuff that happened last night, the night before, last week. So what he's brought to you hasn't changed. And you'll find that a lot of trading groups will always have to innovate and do new stuff. We like to look at it this way. If we can convey to you the clearer picture of your advantage of understanding what the playbook is that these market makers use to run the markets, we've done our job in a way that exceeds our expectations. And you will make money from it if you stay perseverant in the various ways that I'm going to present to you. So what I'm going to try to give you tonight is a gigantic red pill. I can't even spread my arms wide enough to try to illustrate it is to push it down your throat. But I want to get you to the point where you yourself ask the question, do the market makers profit when most traders are in one direction and the market makers are positioned in the opposite direction? I want you to think about that. It's a simple question, a very simple question. And they say themselves, we continuously supply liquidity. They continuously supply liquidity. And I want you to understand at some point in your career that it's his market, his game, his house. And I don't want you to question that, because what happens oftentimes when we show you the template for how to trade in line with him, oftentimes during a trade that is ongoing, price will violently pull back against your position. And in such moments, in these moments of weak-mindedness, you will forget this truth. You will forget that it's his market, his game, his house, and you will fall to clicking out of trades. You won't aggressively enter a trade, but full position. Many mistakes are made when you don't understand that it is his market, his game, his house. So the simple question that's asked, do the market makers profit besides bid and ask spreads? The answer is yes. And nothing in his own words stated above contradicts such a reality. Any attorneys among us, Any people that are expert in language and law, you can look into any of these words. You'll agree with me that there's nothing that contradicts this idea. And again, many times information is given to you with the act of omission. It's not what's said, it's what's not said. And what's not said is this additional area, how they might profit besides just bid and ask spreads. So what entity would have enough money to offer liquidity to a 2.1 trillion a day spot FX market? Right? The spot FX market's 2.1 trillion. The other portions of the FX market are about 4 trillion. A third of the Forex market is in spot. There are other portions of the Forex market, of course, that add up to close to 7 trillion a day. But what entity would have that type of money, of course? And if we're looking at the Dow and the NASDAQ, we need to ask the same question. It's a difficult figure to come by because you have 30 instruments inside the Dow, you have 100 instruments inside the NASDAQ. How do you add up the daily volume and all those? It's a little murky, but the closest figure that I can come to is $383 billion a day running through the Dow and the NASDAQ. So how do you push that amount of volume in and out and actually have buys and sells constantly in the market? Where does that money come from? That's just massive money. That's more than Elon Musk has, right? This is, you're getting into these others that just don't tell you how much they have, obviously. So here's my question for you as we prepped the game board here tonight for you. What entity that has that type of liquidity, right? Answer that question. It's huge. It's giant. And then if you're going to fish in a gigantic fish tank, which is what you're doing when you enter the market, you click into a trade anywhere on this planet, one of 3,000 plus brokers on the planet, thousands of prop firms, tons of institutional traders. Think of the thousands of all of these entities that are brokering. Those all feed back into the center point, which is where the liquidity providers are. And just inside the liquidity providers, of course, is the market makers and the central banks. If you're fishing in a giant fish tank like that, if you're in a huge fish tank, right? Would it be logical to ignore the giant shark that's in the tank? And this is where I philosophically differ with a lot of professionals, which gave a lot of crap to Steve for coming up with this, thinking that it was a gimmick. Oh, he's just trying to get people in. Like there's a smoky filled room, there's a back room where guys are smoking cigars and they're determining which way pairs are going to go. You think it's that unsophisticated? No, it's actually not. So that's the question. Do you want to ignore this or do you want to actually embrace it? And let's ask an even better question. This is my favorite question. This is the part that is the discovery part, which for you, I hope makes sense. Does a market maker have to be neutral to longs and shorts by law? Is there any regulation? This entity's buying and selling to everybody and it's making prices, it's doing all this kind of stuff. All right, where's the fairness regulation? Where's the regulator? Right? Where's the Forest Service? Where's whoever you have in whatever country you're in? Where is the authority that gives them, I guess, the directives? Does a market maker have to be neutral longs and shorts by law? Answer, no. A market maker is not required by law to be perfectly neutral to longs and shorts. If you've been following me closely this long, if you've been able to maintain concentration, God bless you, because I speak fast. I do apologize about that. Bit excited about this work, but no. It's right there. You could read the rest of it if you want, but it's basically trying to juice the original ideas. They're kind of selly and trying to make you think that it's still okay. It really needs to be understood that there's no entity that says that a market maker needs to be perfectly balanced. And what does that mean? That means that in certain times of the day and certain movements in price, they could be deeper into long positions than short positions. Now, what happens if the market moves that way? Well, they, in essence, become as a trader and they benefit by price movements. And what silly person in the craziest of their own mind could sit in a quiet room with this idea that we've just explained to you in 14 minutes? What would you do if you had these types of resources? If you could own price on both sides of the market and you knew that there was a herd out there that was highly agitated in given moments and they all did the same thing in certain times and they were all compelled to do things at the same time, what would you do? Would you, maybe it's the question, do these guys want to make money or don't they? And again, it's at this point, such a simple idea that answers so many complicated questions. And every argument against Steve's proposition that there is a market maker that profits on your moves, every argument is super complicated. And that's usually in law how you can determine if someone's lying. They usually have a big, long answer. When the truth itself is so simple, you can ask these very simple questions, and in one sentence, you can basically get the punchline. So that's the punchline, ladies and gentlemen. What we want to try to show you is how to be one of the better traders that, like a pilot fish, suck up into the belly of this thing and ride the currents with him or her. We don't want to say that market makers are masculine. There could be females in there for sure. So the best traders are able to look at price, walk up to a chart, and assess what the market maker's game is going to do next. It's as simple as that, really. And when you rely on too many indicators, too much crap on your chart, it's a shame when I see it. I'm sorry. I got to point it out. When you have too complicated of a game going on in your brain, oftentimes you're missing this piece. And when you put this piece in, yes, it's good to have technicals. We all use technicals. Carr use technicals. Steve uses technicals. I use technicals. There's various technicals that are necessary. But it's a point of saturation that we don't want to ever get beyond, because if you lose sight of the fact that it's his game, his market, his house, and you don't play along with him, well, that's usually where your win rates start to drop. And what we want to do is we want to understand what is his playbook. Again, we say the statement, it must be complicated, right? Usually things in life that are simple or honest, things that require run-on sentences and 15 pages of information, usually there's some dirt in there. And again, you'll agree with me that the truthful person doesn't worry about the truth coming out, right? They're not going to be offended by it. They're not going to tell you to try to believe something else. They allow you to believe what they believe because they're truthful. The dishonest person has to make up all this garbage. So what we want to do is we want to ask, what is his playbook first? And besides that playbook, we want to try to simplify it. And if I can simplify it for 1, 2, 3, 10, 15, 20, however many are going to grab onto this and go ahead and start to execute this, that's great. That's what I'm here for, is to try to get you to see things. So before we proceed into the actual playbook, I want to remind you that both Steve and I use this term, the dealer, as in the card dealer, and it's a Vegas term, right? And it's a gambling term, the dealer. We don't want to equate the dealer with the brokers. The brokers are basically dealing desks that are actually traders in themselves. And they're not the market makers. There's far more than 3,000 brokers on the planet, but they sit out here in ring number 3. The liquidity providers feed into the brokers. And in front of the liquidity providers, obviously, are the central banks and the market makers. Bank of International Settlement sits at the very center in the banking world. They are the bank of central bank of central banks. So the market makers appear to sit in this ring just inside the liquidity providers, because someone has to coordinate liquidity providers. Because if you watch and see some of these inducements that the market makers like to do, there's too much coordination for it not to have a center point, in which case you have to draw before the liquidity providers, which we understand are where institutional traders will open their accounts, right? A liquidity provider is someone that'll open an institutional account for somebody. If you are in the US, you have to be an eligible contract participant with assets of 10 million and at least $1 million to put up as collateral. You will be allowed into that liquidity provider level. But even that level is not the market maker level. They're one additional center inside of that. So I don't want you to think that your broker is a market maker. Yes, they can move price. They can widen the spread. They can cut your feed when you're in drawdown, get you all nervous. You think it's your internet connection, and the person on chat will tell you that it's your internet connection. And meanwhile, you take a cell phone, which is a completely different internet provider, and you log into your account. And, oh, that one is down too. Right. So you always need to have 2 points of contact with the market to prove that the dealer is not playing games with you. They love to shut the feed. If you're a profitable trader, you start to build a good account. A lot of times what happens is that the dealer will start to identify you as someone that they want to start to, well, provide friction towards. And a lot of brokers don't do this these days. The ones that are doing this, well, it's so easy to spot it. So what they'll do is they'll shut your feed. They'll play games with you. And again, if you have 2 connections to the internet, you can go onto your second device, and you can go onto your second internet service provider, and you can see if that shut is connected to the internet or if it's actually the broker. That's pretty much it. Besides that, the brokers can move pips 10 or so distance. They can move price 10 or so pips. If they get beyond 10 or 20 pips, then they become obvious and people start to leave them. So the brokers really aren't going to move price all that much. Liquidity providers and the market makers are the ones that do it. So I want to basically preface that. So here is a very simplified playbook that is absolutely not complicated, of which I'm going to show you a bunch of examples going back to 2013, certainly recent examples, a bunch of setups that were in line with this. But I want you to start to think about this dialogue and think about internalizing this dialogue for the charts that I'm about to show you. So this is the dealer's book, basically simplified for you. We've got range condition where market makers are not present. Essentially, they stand back and allow the market participants to move price. If they don't engage, the market participants will actually turn things up and down. That creates a range oftentimes. Then we have an inducement, which is a false momentum. Then we have a trapping phase, which is where we have false breakouts, and we have zone blocking, which is discussed in great detail in Steve's course, which has been on the internet for quite some time. You could get his 3-day course. Sadly, it's, I think, a disservice to him, but that's all right. We've built a lot of new information since then that builds on that original information, but you've seen zone blocking if you've seen his pirated stuff. As well, you've got the shift phase, which is where you have stop runs against these trap traders. So it's range, induce, trap, shift. Remember that as we walk through this. And we have this additional part, which is very, very sneaky for these guys to do that. But once you understand human nature, you can see why that repeat stage is done. Where when I'm a dealer and I run the stops against trap traders that were sucked in by the false momentum, I repeat the same thing over because I know that a certain portion of those that I've stopped out will have a desperation to try to make up the losses. We call that revenge trading. And so, ladies and gentlemen, I want to say to you, if you're very new to trading live money, here's a huge hot tip. Never revenge trade in the same instrument you took the loss in. If you must revenge trade at all, try to go to a different instrument. And I say that with a bit of tongue in cheek. You don't want to ever revenge trade. That's ridiculous. That's when you get angry at the market and you put on too much risk on your next trade. And what ends up happening is you get sucked into part of this playbook, which I want you to firmly avoid by making sure that if you have that instinct, if you must revenge trade in an instrument that is not the same one you got stopped out on. Go to another instrument and wait for a setup there. Trust me. Just do it. Okay. My first year in trading was all about revenge trading. I became an absolute professional revenge trader, blowing accounts, all that kind of thing. We all start there. I think it's probably a good idea for everybody to get roughed up a little bit as traders. We're talking, I guess, 2006 when I started that. Seems like yesterday. Anyway, how do you see these market maker behaviors in patterns and high liquidity timings? High liquidity timings. You could type that into Google and you're going to get this generalist answer that, oh, the London session goes from 2 a.m., 3 a.m. to 7 a.m. and the New York session goes to, you get all these strange, you won't ever be told the actual liquidity injection timings. And you know one that's super strong, obviously, if you're trading futures indexes, that's the 9:30 a.m. open. It's an injection of liquidity. When these liquidity injections comes in, the market makers tend to like to use that fresh liquidity to create an inducement phase for which they set the trap and then they operate the other direction, in which case they're a little bit skewed towards one side or the other. So let's just back up for a second. I've given you the overview of the market maker, and I don't want to incline you to believe that the market makers are ever always long or short. They really don't need to be. When you're pushing 2.1 trillion a day in the spot effects market, 383 billion a day in the futures indexes, you only need to be a little bit out of hedge to take advantage of the motions of the retail herd that's caught the wrong way. Okay, so back to our point here, in patterns and high liquidity timings. That's really what it is, the pattern and the timing. Okay, so market makers not present, what do I mean? They're positioned neutrally, they're not driving price. Okay, so let's talk about this. Patterns are statistical. They are never perfect. And this is where, unfortunately, for 14 years of working with Steve, I know he's been in it longer. Carr's been in 15. Steve's been in more than 15. In all of the time of working with people, it's baffling to see and to come to the conclusion that statistically we're talking about something that's a 68 to a 75% win rate. I probably should have said that at the beginning of the presentation. I want to show you a setup that's 68 to 75%. Okay. I probably should have said that. But knowing that and then watching the various human traits exhibit themselves, as an educator, I see this, right? I'm on teams all the time talking to students and getting a sense of where they're at. I've watched this type of thing happen in so many people. I have to cover this psychological proposition for you. Because even if you're shown the pattern, even if you're given the timings, and even though you believe that there is a market maker out there that's doing this type of manipulation, there's still going to be a resistance to you actually profiting from it. And that, ladies and gentlemen, is why I'm so excited to be here tonight with you. It's because so many people will look at these patterns and timings and there'll be one that doesn't work or two that don't work or three that don't work. And it's this mentality of it has to be perfect or it doesn't work. So where did you learn that? Where do you think you learned that? Where did you think you learned that? You learned that in your 20,000 hours of schooling. Okay, so in 20,000 hours of schooling, this was teaching you how to not take Steve's material and turn it into a profit. I'm sorry, it's the truth. A proficient trader must develop the art of being a statistician. If you're trading without statistics, unfortunately, you're subject to the emotions that are going to make you a poor trader. There's a lot of math involved. You need to have mathematics. How do you choose a lot size? How do you determine a win-loss ratio? If you don't have a win-loss ratio and a methodology to determine lot size, it doesn't matter if you're showing a pattern and timing. It won't matter. You're going to fail. And that is unfortunate for everybody. But this is the reality. If I can show you a 68 to 75% win rate setup, this is visually what a 70% win rate looks like. So each one of these red squares is an opportunity for you to fall into this idea of, oh, it didn't work. It didn't work. It didn't work. And I've seen people fall off of it because of this very reason. It's unfortunate, but I've seen it. And being this close to it, and every week I do my compilations of the setups, and I've been amazed that more people don't actually do this and continue doing it and making money on it. It's actually it's completely baffling for me. But then you've got to ask the question, where was the person's mentality? And oftentimes it's inside these losses that all of this flood of, oh no, I failed comes up, or oh no, it's not working. And you start to become suspect of the patterns. I'm going to show you exactly what Steve put out for free in 2013 and show you a bunch of examples of it in recent price, and give you a system that if you stick with the system simply, you'll be in that 68 to 75% win rate and you will make money. So that's it. So again, why do people fail? They fixate too much on the losses. It's a shame. You have to get rid of this idea of failure. And so we're talking a 70% win rate here, which we know would absolutely make you money in any account, any prop firm. If you can maintain 70%, you're going to win. You're going to make money. So that's a C grade in school, right? You're not an A+ student. So I've found personally people that come into this particular methodology that are A students, they have a real hard time with it because everything has to be a 90%. It's not going to be a 90%. And I'm sorry if that's the case. I'm sorry, but I'm letting you know ahead of time that these are the reasons in 14 years of seeing people exceed beyond your wildest. But the story of Melinda, a trader from Australia, who was a truck driver, who during the COVID basically was told, you either get the prickety prick or you lose your job. She says, okay, I'm going to be a trader. I'm not going to drive the trucks anymore. And she learned to trade, and she got her prop accounts above 1 million. And then now she's running her own personal accounts over 1 million, trading this methodology. And so I've got a bunch of stories that are like that. But again, I'm trying to get the people that are still grappling with this idea of a 70% win rate as being something wrong. I want to try to change that for you tonight. So the way you do that is with probabilities and statistics. Very boring concept. Again, it's not super pizzazz. I'm not throwing a fireworks show here, saying there's some hard work here. Scaled risk, what is that? Of all the trading schools you've gone to, of all the trading coaches you've had, how many have taught you how to size risk properly? How many of them have told you how to come to a lot size properly? I've never seen any of these schools teach lot size. And unfortunately, well, they're white labeling to brokers, and they tell you to, this broker works with us and they get a piece of every trade you lose. So I think it's in their interest not to show you how to properly determine lot size. So for me, ladies and gentlemen, I don't want to be a bummer here, but we're going to get into some charts that are really exciting because it shows exactly what Steve taught for free in 2010 and 2013. And it's that statistics, probability, scaled risk. That's going to be 75% of what gets you into the winner circle with this methodology. The patterns are about 25% of it. And I hate, yeah, you don't want to believe that. I get it. But there is so much to this that has to do with statistics and probabilities that I'm going to be giving you a disservice not to mention that to you. And yes, it has that 4-letter word, WORK, attached to it. But again, if you want to win in this business, you're going to have to dip into statistics, probabilities, and scaled risk. And if you look at the retail win-loss ratio, all brokers provide this, domestic US. There's a little bit of fine print that they put across the bottom of the screen. What they show is how many traders win and how many lose. And what we have is a 92% lose and 7% win. This is giant brokers like Owanda. And the thing moves around a little bit. It'll get to 7.3. It'll get to 6. It moves, right? And by law, I have to say that in the United States. How many traders win? There's a certain portion in there that break even. They tread water. Good for them. At least they've learned scale risk and how to not blow accounts, which I think should be the #1 lesson in all trading education. Where is it? Well, we have it. We do it. It takes 6 lessons. I got to sit with you for a couple hours and unwrap your brain and get exponential math in your head. Some of you are quick. You'll get it right away. I understand. But most people have never looked at exponential math in terms of scaling risk at all. And that's really, I mean, it's like learning to fly a jet, but no one's shown you how to actually use the accelerator properly. So you're gunning it right away on the runway and the whole airplane falls apart. I mean, that's the basic breakdown. But generally speaking, it's a 92-7 market. 92% of people lose, 7% win. And I've seen that even inside of our group to some degree. It's not that low of a number, obviously, but I do see this breaking point in some people. And it has nothing to do with them personally. They're good people. They're smart. They're well-intended. They don't have, an inability to pick up the information. It's really that it's these little red squares, especially when there's 1, 2, 3, 4 in a row, that they question everything. And I'll say this, the market makers will stand aside with some of these patterns and wait a week or two before they start up again. And when you actually do chart history and you unwrap some of these setups that we're going to show you, you then can see these diversions of the mean where the market makers actually allow that particular setup to break purposely, because guess what? They don't want to lose this rig, and they won't lose this rig if they do this. So we asked, Steve used to present this class in 2012, always saying, well, I haven't seen a red dot on my head from the laser pointer of the market makers. Well, they were smart to understand that most people won't get past the statistic space. They won't ever use proper scaled risk, and they'll blow accounts purely on emotions, even if they're shown proper patterns. So we really need to basically nail this hammer into the board that there's two puzzle pieces that need to work together as a trader to be professional. It's patterns and timings, or whatever methodology you use, okay? So when you watch Steve tomorrow talk about his strategies and you look at his teachings, think about that piece as being important, but you also have this additional piece, which is the stats, the probabilities, and the risk. And to be honest, the proportion of that puzzle piece really does look like that. It's a huge puzzle piece. And meanwhile, the actual strategy is a small puzzle piece. And I want you to assimilate this, take a deep breath, and understand this is the reality of trading successfully. Statistics, you have to have a win-loss rate. You have to know what the win-loss ratio is of the particular setup you're trading. I don't care if you trade this stuff or you trade other people's things. It really doesn't matter. The scale risk component is gigantic on its own. That's how you won't blow accounts. Okay, so let's get into basic mechanics here. The lower the time frame, the more the market makers can manipulate price. That makes sense, right? So on the small time frames, they can manipulate price. Your weekly chart, your D1 chart, your H4 chart, those are mostly organic. There are enough positions of size that it becomes very cost prohibitive for the market makers to take positions that would actually push these time frames. They do push these time frames for 2 or 3 days, but after that 3 to 5 day window, there's not a exorbitant amount of liquidity that they can use in such a way. So I've tried to explain this before as well, that in central banks, you have a hedging department, which is responsible for international exchange. And below that, you have your market making. So the hedging department is oftentimes going to give the mandates down into those that are in the market making area to actually say how far and how much liquidity is available to them for use in churning the market against the retail herd. Okay, so they don't have infinite capital. And you have to understand, and they do have infinite capital, but they don't have infinite capital from which to expend to really drive a weekly chart, a D1 chart, even a 4-hour chart. So those are more organic. When you get down to the H1, the M15, the M5, these are easily manipulated. So I would, in your mind, draw a line from H1 and below. That's where you're going to see these strategies super shiny, super clear. You're going to see range-induced trap shift all over those time frames from H1 and below. Your higher time frames, those are better for your momentum. Those are better for your high volume areas, otherwise known as support and resistance. Those areas are not as much going to be subject to the range-induced trap shift. Most of that is on the lower time frame. And you get down to the 1 minute and the 15 second, it's absolutely intensely manipulated, but that's why a lot of our traders love the M1 and even the 15-second chart. I love the 15-second chart personally. We have a bunch of traders that love the M1. You'll have a lot of manipulation potential down there. That's where your range-induced trap shift really shines. So the lower the time frame, the more the manipulatability, the higher the time frame, the more solid it is. So I have a suggestion for a trading system here. And that suggestion is for you to take a directional bias in the D1 chart and put in one of these pattern and timing ideas against it on the M5. So let's just present this super simple for you. So directional bias is established on the D1 chart. It's either long or it's short. If it's sitting sideways, ignore it. Don't look at that. Look at instruments that have a strong D1 trend either direction And then in that 5-minute domain, that's where you want to put into one of these range-induced trap shift type of ideas. So what you're looking for is you're looking for this inducement phase that's inside that 5-minute chart to be against the prevailing direction on the D1 chart. And it's a super simple idea. It's super easy for you to profit from this, but I want to make sure that you have a technical understanding of how you can look at a D1 trend in a mechanical form. So when price is above the 50 EMA and your 8 EMA is pointed upward, that's a good technical basis to consider an instrument as being in a D1 trend. Okay, super simple idea, not a lot of complications. Very easy to spot instruments that are in this particular characteristic. Right now, we have Dow that's in this characteristic. We have NASDAQ that's in this characteristic. The NASDAQ gave an amazing setup today from the bottom edge to the long side, illustrating what I just showed you. So if you took a D1 chart of NASDAQ, you identified this particular technical happening, and then you took a 5-minute chart of NASDAQ, maybe a 1 minute, probably need a 1 minute to see it, you'd see that bottom edge reversal that was in line with this higher time frame trend. Okay, so that's a D1 long trend. On the bottom side, same thing. Prices below the D1 chart, right? D1 candles, the candles are below the D1 50 EMA. Okay, 50 EMA is in gold. The price is below the 50 EMA, and the 8 EMA is pointed downward. So the 8 EMA offers an excellent close-in filter. It's not enough just to have price on one side of the 50 EMA. We want to also consider that 8 EMA that's pointing in a direction. So that becomes our D1 short trend. If the 8 EMA is not in line with the price above the 50 EMA, do not trade that instrument, no trade. See how it's eliminated here? See how that falls off? Okay, so when you're trading in a D1 scenario, you're going to have these amazing opportunities that are in line with the D1 trend that I submit to you are excellent for the particular setups you're trading now, or put in one of our, I guess, the mainstay London pattern into that and see what happens to your numbers. Okay, so D1 EMA is pointing upward or sideways. Price is above the 50 EMA. That's a D1 long trend, bottom edge. Price is below the 50 EMA. The 8 EMA is pointed downwards. That gives you what we consider a D1 trend. So what you're looking at here is you're looking at a fundamental momentum market that you're going to wait for the market maker to actually operate against. So here you have a solid basis for a directional bias. Now we want to slot in the lower time frame. So consider any setup that you're currently trading on the M15 chart or below. You could be on a 5-minute chart, a 1-minute chart, and simply put this piece into it, only trading in line with the D1 trends according to this simple rule set. Let's say you have an EMA trading idea on the 5-minute chart, whatever it is, a bounce trade, doesn't matter what the trade is. Think about, if you're in statistics already, chances are you might not be here tonight because you're winning. Statisticians in trading are usually winners. It's incredible the difference of people that are emotional and the people that are statisticians. But if you have the ability to go back into the setup that you're currently trading that's on a lower time frame and just put this piece in, you're going to find that it actually helps the win rate significantly. Your win rate will likely improve because it's very difficult for the market makers. It's very costly for the market makers to go against these D1 trends. They do it, but oftentimes that's usually where we can put in one of our top setups, which we're going to talk about right now. So now let's insert a BTMM pattern and timing onto the M5 chart. It's exactly as Steve brought it out in 2010 when I first saw it, the London pattern. Okay, and let's discuss this London pattern in terms of our playbook so we can look at price and also look at the actual playbook that should be the narrative in your brain when you're trading. Now, self-talk is everything. Oftentimes, we are lured into a sense of self that distances ourselves from the current moment. And that's a big problem. Okay, so before I jump into this part, I want to read to you a quote from a book. The mind creates an obsession with the future as an escape from the unsatisfactory present. So when you lost your trade yesterday and you're now looking at a potential trade today, how oftentimes do you drag that into today? Most of the time you do. And I just want to offer for you guys what book that's from. Eckhart Tolle, The Power of Now. It's an amazing book for traders. If you're a trader, be all about buying up this book. If you had any resistance to what I talked to you about, already, you want to get that book, because if you can stay in the power of now, you're looking at the immediate reality of the market. You're not connecting yesterday to it, which is, again, so many traders have that. So let's talk about range condition. Here's your range. You all most likely have seen this pattern. Don't want to waste your time with it. There's your inducement phase, right? You're going to have some type of false inducement. Then you have a trapping phase, top edge M, bottom edge W. Trapping patterns, you have head and shoulders, all of the types of patterns that we see. And then you have a shift phase. So the London pattern perfectly illustrates this dealer playbook. So what we're talking about is we're talking about putting this pattern into the D1 trend. So you have an organic short market. The organic market, your indicator, which is below the 50. Right now, D1 price is below the 50. The 8 EMA is pointed downward, right? You see that organic market. You can put up a chart of EC right now. That thing has just been a rocket ship. And go back and look at how many of these London patterns are in EC going long. Okay, so I'm opening up a little box of gold here for you. Okay, and in that box of gold is the D1 chart in a D1 trend, either direction, that's sustained, that has a lot of energy to it, and then put in this pattern. So then you wait for the market maker manipulation against the trend. You wait for some type of turn against that D1 trend while you're still in the technicals that we presented to you. You're still in a D1 downtrend. You still have your EMAs all in line. And that's where you're waiting for your pattern and then a resumption of the organic D1 trend. This is a huge piece of the puzzle for those that have been, I guess, looking for a simplified way of being right more than they're wrong. This is a great way to do it. Again, I can prove you wrong if you think this is at all not right, because I have 5 years of chart data on this in a bunch of pairs. I have actual hard data on this. And not many people can say that to you. Not many people are statisticians, honestly. There's only a few people that would be crazy enough to spend their weekends doing this kind of stuff. But for whatever reason, God chose me to be the one that does that. I love doing it. My Saturday night, I love charts. 14 years into it, haven't stopped. So you would insert, if you don't want to use the BTMM entry methodology, you could insert your own lower time frame setup into here. And again, it's the same idea. Systems that are built on this basic structure tend to be more profitable than those systems that fish around just on the lower time frames. And most people get so excited by these charts. When you see what we've got, you're going to have that excitement, but I want you to have a baseline of reality with that excitement. And I want you to understand that any of these patterns are subject to 3 out of 10 times failing. And I want you to be able to say, that's okay. It's okay to be a C trader and make money. It's like the kid in class who always got C's, but now he's a multimillionaire and all the A students are struggling. What is up with that? This is the same kind of thing, okay? So again, bear with me here. The key to this methodology is that you're trading in line with the organic flow of your higher time frames, which are not easily manipulatable, but you're waiting for the signs of the dealer through his playbook to step in. And it's like, again, it's like the odd thing out, right? So when you're watching a scene and everything is static, it's very easy to see when one thing starts to act strange in that picture. So that's what we're talking about here. Is we're talking about this market maker cycle that presents itself first on the H1 chart and begins to throw in this fast move that's against this D1 trend. You're like, whoa, wait a second, where'd that come from? That's the dealer investing in the inducement phase to try to get as many people the wrong direction, so that when that person decides to go long, all of their stops become entries for the dealer. You see how this works? Again, it's super simple. Okay. And it's again, simplicity. Here it is the other direction. If you guys want to take screenshots of this, multi-million-dollar strategy right here. I mean, this is $1 billion strategy. Really. I mean, this is really good stuff. The guy come at you it's coming up to 5 years of really being all over this thing. At least this particular, on a couple other strategies, but this one's been a kind of a pet of mine since 2021. So you got your organic long, you have your odd, strange pullback against that just doesn't look right. It's super fast to the downside. It's obscene how quickly price drops. And then you start to see these inducement phases. Those are usually in threes. You can start to see the trapping patterns, the long wicks. You see price pulling back and trapping, but not being able to take out that bottom part, staying within the price blocking. And then you start to see the reversal, and then it pulls back fast, and then it just takes off in line with the D1 trend. It resumes the organic direction. Okay, so that's the narrative. And again, here it is, the original way we presented it. If you want to take a screenshot of that, I invite you to do that. This will be a big help to you and your trading and your equity curve. So let's look at a D1 chart here. I'm going to just take myself off the screen for a moment and let you guys and gals examine this chart. And you tell me Are we in a D1 trend condition now? Go ahead and type it in. Type in what you see here. We're going to do a little pop quiz tonight with this idea. Okay, good, good, good. And again, throw yourself on the edge of these charts. This is the WSM viewer that generated these charts. You can see up here the timing. 2025, January 1st, January 17th, rather. January 17th, 2025, 6:30 a.m. on a D1 chart. Throw yourself on the edge, because from the edge is where you're going to trade, right? That's why it's so important for you to get out of the past as best as possible. Get this book. Get that book, Power of Now. It's unbelievable. I'm going to read that line again. There's going to be another opportunity to read that line, I'm sure. Okay, so you all seen it. Simple. Where's price in relation to the 50 EMA? That's the orange line right here. It's below. Which direction is the blue line pointing? It's pointing down. Super simple idea. That is a D1 trend. And at 6:35 a.m., what do you see on the screen here? This is a 5-minute chart. So I went from a D1 chart to a 5-minute chart. So I really want you to understand that. And that's why we put MTF in the bottom of the screen here. Multi-time frame. You always want to be multi-time frame. You want to be smart on all time frames. Pardon me. Steve often quoted the market makers as saying people are dumb on all time frames. That means that we need to be smart on all time frames. So what do you see on this 5-minute chart? You see one of these, right? Type 1 London pattern, 5-minute chart. Absolutely clear. This also showed clearly on the 15-minute chart. You can see the nice wide M formation coming up into the male. Okay. And this is what it looked like on the edge. So we like to train people when we teach these patterns to cut these patterns to the edge constantly. So you see what it looked like before it made the move. So you can